संसार हो, अति उच्चतम जीवन बने, परमार्थमय व्यवहार हो। ना हम रहे अपने लिए, हमको सभी से गर्ज है। गुरुदेव ये आशीष दे, जो सोचने का फर्ज है। हम हो पुजारी तत्व के, गुरुदेव के आदेश के, सच प्रेम के नित नेम के, सधर्म के सत्कर्म के, ओझे झूठी राह की, अन्याय की अभिमान की, सेवा करन को दास की, परवाह नहीं हो जान की। छोटे न हो हम बुद्धि से, हो विश्वमय से ईशमय, हो राममय और कृष्णमय, जगदेव में जगदीश में। हर इंद्रियों पर ताव कर, हम वीर हो अति धीर हो, उज्ज्वल रहे सर से सदा, निज धर्म रत खंबीर हो। अति शुद्ध हो आचार से, तन मन हमारा सर्वदा, आध्यात्म की शक्ति हमें पल भी नहीं कर दे जुदा। इस अमर आत्मा का हमें हर श्वास भर में गम रहे। गर मौत भी आ गई, सुख दुख हमसे सम रहे।
So, good afternoon, everyone. As you all are aware that today our keynote speaker, Ms. Pooja Mutneja, as well as our speaker, Vaishnavi Raghuvanshi, both have joined directly, joined us directly from UAE in this virtual webinar. They are both sitting at Dubai only today. And Pooja is director with Perspective Tax Consultant, and Vaishnavi is also working with them. So, without taking much of your time, I request Pooja Mutneja to please initiate the discussion on today's topic, that is overview of UAE taxation. Over to you, Pooja.
Good afternoon, everyone. So at the very outset, I want to thank Bhupinder sir to invite us, and it's a privilege to be a part of the team and speaking on a topic which is very close to our heart, which is UAE taxation. So as sir said that we are sitting in UAE and we are speaking from here, we've seen the journey of the UAE evolving over the years. We've seen how UAE in the last few years has significantly changed. Earlier, UAE was known as a low tax jurisdiction, a country with light compliances, highly friendly for the businesses who want to have their businesses with less compliance headaches. But the UAE that we have seen is quite different. Over the last few years, UAE has come a very long way. There has been a significant evolution in the UAE compliance landscape. The UAE has aligned itself with international standards and introduced taxation and some very important compliance measures. Before we understand the UAE taxation and its overview, we would first like to understand how the UAE actually works. So we would first talk about the architecture of UAE. The UAE is comprising, it's a federation of 7 emirates, like we say states in India. So it's a federation of 7 emirates formed in 1971. These 7 emirates are Abu Dhabi, which is the capital of UAE. Then there are Dubai, Sharjah, Ajman, Al Quwain, Ras Al Khaimah, and Fujairah as the 7 emirates. Now, these 7 emirates together form the country, the United Arab Emirates. And why we're discussing this is because the taxes are levied at federal level, the VAT, the corporate tax, the excise. All these taxes apply at federal, that means the UAE-wide taxes these are. And there are certain taxes that also apply emirate-wise. Very few, but there are certain things like, specific oil and gas industry, some banks, they are being levied emirate level taxes, which are collected by the particular emirates. So today we are going to focus on the federal taxes, which are levied at the UAE-wide level. We would also like to see the journey of the taxation in how the taxes have progressed in the UAE. So the journey of taxes has been very, very satisfying, I would say, because this is the time when we were in UAE and the whole landscape shifted. In 2017, it was excise tax, which was implemented on certain manufacturing of products like tobacco, like energy, and certain highly concentrated sugary drinks. Excise taxes are again levied at federal level and they prevail in the UAE. But the major reform in the tax landscape came on 1st January 2018 when the VAT was introduced on goods and services. A flat 5% rate of VAT was implemented on goods and services. This was the time when UAE actually started shifting from a no tax jurisdiction to a low tax jurisdiction. Then came in 2019 when a major reform again, economic substance regulations were implemented in the UAE. That means that the businesses were just not required to open up a company here and operate from elsewhere. They were required to have an economic substance in the UAE where the government was promoting the companies to have an actual operational economic substance in the UAE. Country by country reporting was introduced, and then the most awaited, the major reform came in 2023. 1st June 2023, the corporate taxes were introduced. A flat 9% rate on businesses' taxable income was introduced. In 2025, again, domestic minimum tax has been implemented. 15% minimum tax for large M&E groups has been implemented. So as we see the journey, we see how UAE has come a long way and it has changed. It has followed one by one introduction of taxes from being a low tax jurisdiction to becoming a mature or sophisticated business environment, more regulated. It has come a long way. The UAE was earlier put up into a list which is known as a grey list, which is called an increased monitoring list of the Financial Action Task Force. Till 2022, it was a part of the grey list, but then the UAE implemented reforms and now it is out of the grey list. It is no more a part of the increased monitoring list of the FATF. So this shows that how UAE has put in a lot of efforts to align with the global practices and the standards. Now, over the next few hours and minutes, I would say we would look into the major elements of the UAE taxation framework, how they work, on whom they apply, how they apply differently to different businesses. We are going to discuss that. And as we walk through today's session, I would encourage everybody to look into the UAE taxes, not just as tax rates or compliance deadlines, but see it as an evolving business ecosystem that the UAE has developed over the last years. So with this, I would invite my colleague Vaishnavi to take it forward and explain the UAE corporate tax. Let's begin with that. It's over to you,
Thank,
Vaishnavi.
thank you so much, Pooja ma'am and Bhupin sir, for giving us the opportunity to present the most close topic in front of all of you. And thank you, Pooja ma'am, for the insightful introduction of the journey of the UAE, how the country was built, and how this landscape, tax landscape is coming in the country. And good afternoon, everyone, whosoever who all are here in this session. And my name is Vaishnavi, and for the next few minutes, I'll be walking you through the practical side of UAE taxation, starting with different types of taxes that exist in this country: direct taxes, indirect taxes, who administers them, who prepares the law, who are responsible for making all the compliances being done, and how businesses actually interact with the system and the tax system. From here, we'll go much deeper into two taxes that matters most for the business operating here. We will be walking in the direct taxation, corporate tax, and the indirect taxation, VAT, as GST is there in the India, covering the applicability to whom these taxes are applicable on, what are the rates of these taxes, what are the key reliefs that are available to the taxpayers, and all the keynotes which you are aware, you as a profession should be aware of. We will be starting the very first with the bifurcation of the taxes uh, between direct and indirect tax. Before that, I would just like to add what Pooja ma'am added about the seven Emirates, how it works in UAE. We have UAE, and whenever you want to start a business in the UAE, you are required to take a trade license. Once you take the trade license, you need to start, you need to, the very first step is that where you want to incorporate your company. For that purpose, UAE is divided into two segments. One is the mainland and another is free zone. Why it is important for us to understand this bifurcation? Because the tax reliefs, few of the tax provisions are depend on whether your company is incorporated in the mainland or in the free zone. All the seven Emirates have their own mainland authorities, and entirely in the UAE, we have 40 plus free zones. Free zones have few extra relief from the tax point of view, and that's why sometimes you might have listened that companies take decisions that they want to get incorporated in the UAE, that too in the free zone. In the free zone, we have two bifurcation. One is the designated zone, one is normal free zone, which are not designated zone. Again, these two bifurcations are important because basically, if you are in general free zones, most of the parts you are treated as good as mainland. But when your company is incorporated in the designated zone, it's kind of a sales area in India, where we say that in India, Income Tax Act's few provisions are provided for the companies which are incorporated in SAES. Same work in the UAE. Few reliefs are provided under VAT and under corporate tax for the companies who deal in the goods or who do the business from the designated zone. These are for the tax purposes, these companies are being, or these area are being treated as that they are outside UAE. They are not part of UAE, so they need to be fenced. Custom duties are there, custom regulations are there, like that. So the entire corporate tax and VAT, what we will be discussing further in this session, there will be provisions where I will be explaining you that how these taxations are applicable on mainland and free zones. So we have to keep this bifurcation in the mind. Now, starting with, I'll just give a brief of direct and indirect taxes which are currently applicable or in existence in the UAE. In the direct taxes, as we all know that these taxes are directly imposed on the income and they are not passed to anyone else, like which are there in the indirect taxes. So the very first part of direct tax in the UAE is corporate tax, which we will be covering in this session in detail. In the UAE, it's 9%. A tax rate of 9% is imposed on the profits. It's not income tax because it's not on personal income and all the income. Majorly corporate tax is on the business income, which again we will be discussing in detail. Second is domestic minimum top up tax, which is now applicable in the UAE from January 2025, which is applicable on M&E group companies, and 15% minimum taxation will be imposed on them, because the focus of the UAE, and if we see that how UAE is preparing the taxes or taking the decisions or implementing the taxes, is to make the UAE in same provisions as there for OECD pillar 2, to make it more better place for businesses to work. Then we have withholding tax in the UAE. Like in India, we have TDS, we have TCS for the non-resident companies or UAE sourced payments. If going to a non-resident, then there needs to be a withholding tax, which currently is 0%. So in the law, there is a provision that when you are making a payment to a non-resident company, a customer, a vendor, or anyone, then you need to deduct withholding tax. But currently, they have capped the rate 0%. So practically, it's not yet being followed by the company. But going forward, we expect that the rates will be increased to the standard rate, and then the withholding tax provisions will also be practically implemented. Then again, we have some Emirates level taxes, which are basically on banks, oil and gas based companies. For that, each Emirates have their different laws. And then these are not on the federal level. Dubai choose their own laws, own rates to get these income tax. Then Abu Dhabi choose their own rates and own law. So for this, these taxes are also imposed directly on the income, but not on the UAE level as a whole, but on each emirate level. Now moving to the indirect taxes part, we have VAT, which is value added tax, which is GST in India. And here we have 5% standard rate for all most of the goods and services. And it was initially like access was introduced first, but on the UAE wide level, the VAT was the first welcome move of taxation in the UAE. We have excise tax, which is on tobacco, energy drinks, sugar drinks, and all, and which has been implemented in the UAE from 2017. Then we have custom duty. Whenever any companies wants to import goods in the UAE, custom laws will be applicable on them. The standard and most general rate is 5%, which is uh, as equivalent to the VAT indirect tax law rates here in the UAE. And then we have some municipality taxes which are imposed on hotels, restaurants. We have few taxes which are on property transfer fees whenever you want to transfer any properties. So those are the taxes covered under indirect taxations. Now moving forward, this entire session we have divided into two sessions. First, we will be discussing the direct tax, most of the provisions of corporate tax and DMTT withholding tax. And then we will be moving to the VAT indirect taxations. Before moving to corporate tax, we would just like to discuss that these laws are there. These laws have been started from 2017, and now UAE has seen a big journey of moving from no taxation to VAT to corporate tax, and now OECD Pillar 2 provisions as well, which all authorities are involved in making these provisions, these laws, decisions, and then administers those laws. We have Ministry of Finance, which we say MOF here. The Ministry of Finance is the authority that sets tax policy, issue decisions, law. Then if they see that any law is all the taxpayers in the country or the businesses have so many questions about it, the language is not clarified, then they issue public clarification, then they issue FAQs for that. They also conduct so many sessions for the taxpayers to understand the law, because the law was new previously and taxpayers were expecting more learning sessions, more clarifications from the authority. Then Ministry of Finance also negotiate between the countries for having tax treaties. Then they represent UAE on the OECD level to make the international taxes easy for the country. Then we have Federal Tax Authority. Federal Tax Authority is the authority which directly interact with taxpayers. Federal Tax Authority is the one where we file the corporate tax, we file the value added tax. If any penalty is being imposed on the taxpayers, it's being done by the Federal Tax Authorities. They issue the audit notice, they check the voluntary disclosures, they issue the private clarification. So all the administration of this tax laws is being done by Federal Tax Authority. Then we have few more departments for emirate wise taxation. Each emirates have their tax department that sets their own policies and then who regulates the taxation and collection of tax there. Then we have here tax dispute resolution committee, which is where if there is any dispute between federal tax authorities and taxpayers, any audit is going on, and if taxpayers have any disputes with the notice or the decision of federal tax authorities, tax dispute resolution committee is the one that deal in this case before the court. I'll just hand it over to Pooja ma'am to give a brief of corporate tax so that I can take it over from there. Thank you.
Thank you, Vaishnavi, for explaining how the UAE tax framework is structured. So, just to summarize, the UAE tax framework is structured into mainland free zones. Then the free zones are further structured into designated zones, not designated zones. And these would be essential to understand the further slides. Also, the authorities, the federal tax authorities, the Ministry of Finance, who are involved in the key decision and the policy making, plus their administration. So, in the upcoming slides, now we are going to take a deeper dive into the corporate taxes and see the applicability of corporate taxes. Now, as the name is suggesting, it's a corporate tax. That means it is levied only on the businesses, on the companies. Now, some people may be wondering that what about the personal taxes, the individual taxes? So at the moment, there are no individual personal taxes in the UAE. It's only on the corporates. Now, in the upcoming slides, we are going to talk about how these corporate taxes would be applicable, on which businesses it would be applicable. Are there any thresholds? How we are going to compute the corporate taxes? What are the registration and the compliance deadlines? And talk about some recent developments in the corporate tax zone. So over to you, Vaishnavi. Please take up the slides.
Thank you, ma'am. So, starting with that, why the corporate tax was introduced in the UAE and what it means in essential. Is it as same as income tax in India or there is any difference? So, the very first reason or the major reason of introducing the corporate tax in the UAE was to make UAE the place in compliance with the international norms, because in UAE there are many countries people who come here who do the business. International businesses are on very wider level which we see in the UAE. So the focus of the government is not just to have a place to do business, but to give the ease to those businesses to comply with the international norms so that the taxes does not become the reason for not choosing UAE. Then also to diversify the revenue of the authorities, because back to a decade or 10-15 years, maybe the UAE was majorly depend on the revenue from the oil and the natural resources, but to diversify the revenue was also one of the reason to introduce the taxes here. Also to make what I covered in the first point, to make it more competitive, a investment hub where still the rates are less, the rates are not as high as in many of the countries in the world, but still you cannot now define the UAE as a tax haven country or a country where people are just coming here to get the tax benefits. So here taxations are there, more tax regulations are still there on a competitive level. Now, what is corporate tax? But Pooja ma'am also explained in the previous slide that this is not tax on all the income. This is tax on the corporates, on the businesses who are doing, the companies who are doing businesses in the UAE, or the individuals who are doing businesses in the UAE. But then what about the income of the individuals? Like we are earning salaries, or if anyone is earning investment income, anyone is earning real estate income, what are the taxation of that? Taxation on that, is it covered in the corporate tax? So currently, no, we do not have any personal income tax in the UAE. So the salaries are not covered in the taxation, they are tax free. The personal investment income are not covered, and even the personal real estate investment incomes are not covered in the UAE taxation. So if I have a property here, I have just invested as an individual a property here, and after 5 years, I find out that now I have a good rate. I want to sell this property. The capital income that I would be earning would not be a business income because I do not have a business of purchasing the properties and selling the property. I, as an individual, purchased a property. After 5 years, I find out a good rate. I sold it. So it would be treated as a personal investment income, and it will be out of scope from the UAE, from the corporate tax point of view. Now, I would be covering who are the taxable persons, because the corporate tax is on business, but now who will be covered under the corporate tax and who will be treated as a taxable person. So the concept is divided into the resident taxable person and the non-resident taxable person. The bifurcation between the resident and non-resident is required because what income will be taxed depends on whether the company is being treated as resident or whether it is being treated as a non-resident person. So any company which is being incorporated in the UAE, either in mainland or in free zone or in designated zone or in any offshore area, any company which is having a trade license of the UAE is being incorporated in the UAE is covered as a resident person. Also, any company which is not incorporated in the UAE but effectively managed from the UAE, which in the taxation terms we say that has POEM in the UAE. So let's say a company is being incorporated in the India, is having a license or a certificate of incorporation from India, but all the decisions are being taken here, all the key persons are sitting here, all the business is being in the UAE, and the POEM test is being passed for the UAE, then that country will also be treated as UAE resident person. This is what we discussed about the companies, which is juridical person. What about the natural person? Because I said in my previous slide that most of the income of the natural person are not covered in the UAE. So for the natural person, if I have to do a business in the UAE, but I do not want to have a LLC or a partnership company or a limited liability company, I want to do my own business, then I have to take a trade license, which is a sole establishment trade license in the UAE. And that sole establishment trade license is because here you can't just do business without having a trade license, that is not allowed. So you have to take a license which would be a sole trader trade license, and then I will be treated as I am a natural person doing business in the UAE. For natural person, there is a one very important threshold that you need to remember. If I am doing business, that doesn't mean directly corporate tax is applicable on me. That revenue of the business needs to be more than 1 million in a calendar year. That means from January to December, if the sales that I am making, the revenue is more than 1 million, then corporate tax is applicable on me. If it is 900,000, 800,000, 500,000 AED, which is any amount less than 1 million, I am still outside the scope of corporate tax. So for juridical person, once you are incorporated, you are in the scope for corporate tax. For natural person, which are not companies where the liability is unlimited, where you are doing as a sole trader, then we have to see the revenue for a calendar year, which is January to December. If it is more than 1 million, you are in the scope of corporate tax. If it is less than 1 million, then you are outside the scope of corporate tax. If you are being treated as resident person, then which income of your will be taxed? Your entire global income will be taxed. The income that you are earning in the UAE and the income that you are earning from outside UAE. The whole income will be taxed with the standard rate of 9%, which we will discuss further in the session. Now, for non-resident person, if any company which is incorporated outside UAE, let's say in India or US or UK, but they are having their branch in the UAE or any fixed establishment in the UAE, which we in the tax language we say that that entity is having permanent establishment in the UAE. So if you have a permanent establishment, you are earning UAE sourced income, you are having a office here, you are having your people here who are getting that business or the income from the UAE, you will be treated as a non-resident person having permanent establishment in the UAE. And then your which income will be taxed? Your only UAE sourced income will be taxed because the company which is in UAE, which is in India, that's having a branch in UAE, may have a lot of income on the global level, but that entire income will not be taxed. Only the income that you are earning from UAE office, from UAE branch, that will be taxed with the same rate in the UAE. Now, what all incomes or who all are outside the scope of corporate tax, which we already discussed? If you are earning salaries, if you are earning personal investment income, if you are earning real estate investment income, not real estate business income, but if you are earning real estate investment income, or if any natural person is doing business, but the revenue of the business is less than 1 million, then still you are outside the scope of corporate tax. Then we have certain exempt entities, which are government entities, public benefit entities, investment funds, pension funds, social funds. Then few conditions are provided in the law that you need to qualify those conditions. And if you are qualifying those conditions, then you will be exempt from the corporate tax. These exemptions are basically provided on a wider level for public benefit to the government entities. Now, when we know that which entities are covered in the corporate tax and on which income they will be required to pay taxes, resident and non-resident, the next I would be taking is at what rate we will be paying taxes. So we have a standard 9% rate here and a standard 375,000 AED threshold, which is approx $100,000. So if you have net profit, taxable income, we're not talking about the revenue, but now we're talking about the net taxable income after doing all the adjustment up to 375,000, there is no tax, like the 0% tax. And whatever profit you are earning above 375,000, there is a standard 9% taxation. So if I'll just take the example which is there on the screen, if a company has calculated its taxable income and the taxable income is 1 million, then up to 375,000, the tax will be zero. It's 0%. Then above 375,000, the balance amount of 625,000, which is 6,25,000, they will be paying 9% taxes, which is 56,250 AED. So the effective tax rate, if they will see that how much tax they have paid on their net income, it would be 5.6%, because they have not paid any tax on the first 375,000. Then we have a 15% tax rate starting from January 2025 for the MNEs companies. So the companies who on the group level have 750 million and more revenue and qualify as a MNE company, they will be covered under Pillar 2 DMTT transaction and they have to pay effective tax rate of 15%. We still have a few more reliefs which we will be discussing later in this session, where even the resident company, even the companies which are covered in the scope of corporate tax can still qualify for 0% tax rates. Like free zones can qualify for 0% tax rates, provided they comply with few conditions. Before moving ahead on the calculation part and on the reliefs part, I would like to discuss a very key note or a very key concept of tax group in the UAE, which is currently not available in many of the other countries' income tax rules. So UAE works more over making the tax easy or making the compliance as easy as they can for the taxable persons. So they provide so many options through some or the other concepts, some or the other provisions where taxable persons can have an option to make their compliance easy. What tax group means when parents and subsidiary relations are there between the group entities. Now, parent and subsidiary relations are not 51% shareholding, but when two entities or more than two entities are having 95% common shareholding. So a parent is there, and then the parent have many other subsidiaries where they hold more than 95% of the shareholding. And most of the times it happens that they all are group entities. Majorly one entity is having so much of control. 95% control is a higher level control, almost closer to 100%, and they do not want to make so much complications. They do not want to file so many returns, calculate the taxable income for like 7, 8, 9, 10 times number of the group entities. Then they can make a consolidated entity for the tax purpose, and they can name themselves as a tax group. So let's say company A is there, which is a parent company, and it is having five subsidiaries. So total they have six entities. Now the group does not want to have the compliance cost, the compliance regulations for these six entities. They have an option to make a group and to be treated as one for tax purpose. There are few conditions that they need to meet, that the shareholding should be more than 95%. They should not be exempt entity, and they should follow a same financial year. They should have a same accounting standard, and they should be resident. If you are a non-resident entity, then this provision is not applicable on you. But if these few conditions your group is qualifying, then you can apply to FTA to be treated as one entity. You do not want to treat yourself as seven entities or six different entities. Then there is an application that can be filled on the portal. You can provide your details, you can provide your shareholding pattern, and you can make an application that we want to file one consolidated tax return. Now, there are two questions that I would like to take before moving ahead with tax group. The one condition is same financial year, because we are coming from India. So in India, from the taxation point of view, we do not get to choose our tax year. It's April to March. It follows that your tax period for either you are a company or you are an individual, your tax period is April to March. How does it work in the UAE? If you are a company, that means if you are a juridical person, then you get to choose what financial year you want to have, what tax year you want to have. You can have January to December, you can have February to January, you can have April to March. You can choose as per your global standard, but you just get an option like at the time of doing the registration application, you have to choose that what tax year you are going to follow. In future, if you want to change, then you have to make a separate application for change in the tax period for future periods. So that's why this condition comes here, that for the tax group, the entities needs to follow the same financial year. Now, why a group may opt for tax group and why they may not opt for tax group, what are the pros and cons of this concept, is what we are discussing now. So when you have a tax group and when you make a tax group, your tax group application is approved, you file a single consolidated return. So you have to consolidate your financials, which are also as per IFRS you need to do if you have parent subsidiary relation. So you file a single tax return. Then if you have losses, like one entity is having profit and another entity is having losses, that gets set off. So that loss, the another entity will file its own tax return, carry forward the loss in the future period, and the first entity will pay taxes right now. Will have a cash flow issue for the group as well. So you can offset your tax losses. Then when you have parent subsidiary relation, arm's length principle comes in picture, transfer pricing comes in picture. You need to have all the transactions at market price. Those complicated transfer pricing regulations, arm's length regulations got reduced here, because when you file a consolidated tax return, you need to eliminate all the intra-group transaction. When you eliminate all the intragroup transactions, then there is not much requirement of transfer pricing or arm's length transaction. There are still few listed transactions where you still need to follow transfer pricing, but on the wider level, you do not need to, because those transactions are anyways at the end gonna be eliminated while filing the tax return. So when the focus of the group is to reduce the compliance burden, when the focus of the group is not more on the cash or the tax part, but on the compliance part, they do not want to worry much about the compliances. They want to make that part easy. They go ahead with the tax group option. Now, what is the disadvantage or consideration are there for which the group is still do not opt for tax group? Is that one of the major is the 375,000 threshold. So what we in the very starting I told you that till 375,000 the tax rate is 0%, and after 375,000 the tax rate is 9%. When you form a tax group, you only get one threshold, 375,000. So let's say you have six companies filing different tax return. Each company will have their own 375 threshold. But if you are filing one tax return as a tax group, then your tax group for all the six companies, there is only 10% bracket, which is 375,000. So you are losing that five 375,000 0% gap. Sometimes companies when calculate, they do the cash flow management, they do the pros and cons. So this becomes one of the major consideration for not opting for tax group, because there is a tax liability that get increased in this case. Second, when each company file their own tax return, they are responsible for their taxable income, they are responsible for their tax return for their businesses. But when you file the return as a tax group, a single return, then all the entities which are part of tax group are jointly and severally responsible for the entire group corporate tax liability. So that increase the scope of the liability on each entity. Then there are few consolidations are required. Special rules are there to consolidate the taxable income, which usually may not be required for the tax purpose or other purposes. So that add on one of the compliance requirement for tax group if you're opting for tax groups. So if you will ask me to summarize on the tax group part and also on my practical experience that how companies choose whether they want to go ahead with tax group or not, then the compliance easy option for the companies are forming the tax group. But if they see that losing 375,000 on each entity is a bigger cost than for them than to have a compliance cost, then they do not go ahead with tax group, and then they keep all the entities separate entities. Going further, I would be taking what exemptions we have and what reliefs we have in the corporate tax regulations. Before that, I would just hand over to Pooja ma'am to give an overview of exemptions and relief available in taxation.
Thank you, Vaishnavi. So, as we have discussed in the previous slides, that how the corporate tax is getting applicable on the corporates and not the individuals. That means any individual who is earning a salary, a wage, a rental income, personal investment income, all these are outside the scope of UAE corporate tax. If an individual is engaged in a business by taking a license, say a sole proprietorship. Now, sole proprietorships are treated as individuals doing a business in the UAE. Then the threshold of 1 million dirhams gets applicable. If your turnover is more than 1 million dirhams, if you're an individual, like a sole proprietorship, doing a business in the UAE, and your turnover exceeds 1 million dirhams, you come under the ambit of UAE corporate tax laws. On the corporates, irrespective of any kind of a threshold, you still fall under the ambit of UAE corporate tax. You still need to register for corporate tax and file your tax returns. Now, moving here, we will talk about exemptions and reliefs. So as we have seen that the tax rate is 9% flat up to a net taxable income. That means the net profits that we are talking about, a taxable income of 375,000 dirhams. So up to 375,000 dirhams, there is a 0% tax rate. Over and above any taxable income above 375,000 dirhams would be taxed at 9%. There are certain entities that are exempt, which we have spoken about, like public benefit entities, government entities, some qualifying investment funds, which are already exempt outright from the corporate taxes. The tax rates are low already, but to ease out, the authority has still come out with certain more exemptions and reliefs. So, to summarize, we will be speaking about 4 key reliefs the authority has given. One major relief is given to small businesses. Now, what are these small businesses? As the relief is small business relief, the name suggests that it is given to support the small businesses. That means the businesses that have a turnover less than 3 million dirhams. The businesses with a revenue of less than 3 million dirhams have an option to elect for a small business relief. That means they still need to take a corporate tax registration, file their tax returns, but there would not be any tax liability on them. If the turnover is less than 3 million, opt for a small business relief and there would not be any tax liabilities. Simple. Then we also have another relief which is given to qualifying free zone persons. Now, what are these? As we had discussed that the UAE is divided into mainland and free zones. Now, for certain free zones, the authority is encouraging that, you come and do your business in the free zone. So there are certain businesses, like say, just for an example, it's called a headquarter business. Like if you have a free zone company and you're doing a headquarter activity in the UAE, that means you have multinational organizations, you have organizations in different countries, and you have created UAE as your headquarter. In that case, the authority is giving you a relief from corporate tax and saying that your income will not be taxed or you will get a zero tax benefit if you set up your headquarters in the UAE. Right? There are certain conditions attached to it, which we will be discussing in detail. But the objective of authority is to encourage certain businesses to come into the UAE and have an operational economic business in the UAE. So again, this is an encouragement from the side of authority. Third, we have a participative exemption. A participation exemption again says that if you are receiving dividend income from a UAE company, then your income, this dividend income, would be exempt. The simple reason here is that the company itself is paying taxes on that particular income, and you are receiving a dividend. That means a profit distribution from that company. So that income becomes exempt in the eyes of law because another entity has already paid tax on it. Then there are also certain group and restructuring reliefs. So this can be seen as if we have a qualifying group, like we have spoken about a tax group, there's also a concept of a qualifying group similar to that. If we have a qualifying group, we have an option to transfer the loss of one entity to offset the profits of another entity. Like one entity has a taxable loss, another entity has a taxable income. So you can offset the taxable income with another group entity's tax losses. So this is some kind of reliefs and exemptions that have been provided from the UAE Tax Authority. Despite the tax rates being so low in the UAE, comparatively, the effective rate comes very low. The authority is still encouraging businesses and supporting businesses with these reliefs. So let's study these reliefs in detail. Vaishnavi? Unmute, please.
I'm sorry. Okay, thank you, ma'am. So, starting with the small business relief, which ma'am has just spoken about or brief about, that these businesses, this relief is to support the small businesses in the UAE and small resident businesses in the UAE. So, in the starting, we have discussed about the taxable person, that we have two types of taxable person, resident and non-resident. The small business relief is available to the resident taxable person who are having the revenue of less than 3 million in tax period. Now, this revenue includes sales or any indirect income, whatever comes and sits on the income side of P&L. By combining all them, if your revenue is less than 3 million, then you qualify for small business relief. Now, as I spoken in the starting, or I discussed in the starting, the reason or the intention of the authorities here to make the law easy or to make the compliances easy for the taxable persons. The small business relief is one of the major part of that intention. Till last month, or I think 10 or 15 days before, this relief was available till 31st December 2026. So when the corporate tax law came in the starting, the authority says that small businesses have this relief of not paying any taxes until 31st December 2026. But very recently, in the last month, authority, or I think last in the last 10 days, authority issue a new decision, ministerial decision, and then they says that they are extending this relief till 31st December 2029. So now for the next 3 more years, the businesses can elect for this relief. Now, what does relief, because we are again and again saying that small business relief, what does this relief means? This relief means that if your revenue is below 3 million, authority, and you are opting for a small business relief because it's optional, it's not mandatory, you will be treated as you are having no taxable income. So you have a revenue of 3 million, you have a net profit of 2.5 million. Ideally, taking the slab of 0% and 9%, you would have to pay taxes. But if you are opting for a small business relief, that 2.5% taxable income will be disregarded, and it will be said that you do not have any taxable income, you have zero taxable income, and then no taxes payable. Second benefit of a small business relief is a simplified tax return. So UA tax return is divided into 7 to 8 segments in which you have to provide your financial statements, you have to disclose a few related party transactions, you have to provide each and every line item of your financial statements. I will be discussing later in detail how the tax return is being filed. So it's divided into 7 to 8 segments. But if you are filing a small business relief, it's a simplified return. On the reporting point of view, you have to report about the taxable person, you have to report about few details of your businesses, and then you have to report the revenue of the company. Then at the time of filing of the return, you do not need to report entire balance sheet and P&L and the calculation of taxable income. You only need to report the revenue part in the tax return. So that makes the compliance simplified for the taxable person, uh, helping small businesses not to worry much on that part. Then, while discussing this, I said that this all is applicable only when you are choosing to elect for a small business relief. But then the question comes that I have the option to pay 0% tax rate. I have an option to file a simplified tax return. Then why I am not electing for a small business relief? What are the reasons I would not be electing for a small business relief? So one of the key reason for which businesses choose not to elect for a small business relief is when they have losses. Because if you are filing a simplified tax return, you do not get to carry forward your loss. But if you are filing a full return as a normal taxable person, a detailed return, and you have a loss in this year, you may utilize that loss with your future income. So sometimes businesses says that the compliance cost of filing the full return is not that much, but our loss is substantial and we are expecting a major income in the future. So we are not opting for a small business relief. We will be filing the full return. Then the second question comes that this relief started from 2024 now till 2029. Can I choose to elect for a small business relief in 1 year? Can I choose not to elect for a small business relief in another year? The answer is yes. You can choose that while filing the 2024 return, you are electing for a small business relief, then filing 2025 return, you do not want to elect for a small business relief, then in 2026 you feels like I want to elect for a small business relief. So this option you will get while filing every tax return, provided you are eligible for that option. If you are eligible, then you will get this option every year till this relief is in substance as of now, December 2029. And you can choose that whether you want to go for it or whether you do not want to go for it. Second, one of the major thing is you still need to register for tax return, you still need to file the tax return, you still need to maintain the record. So the compliances are there, but the compliances has been reduced. They are not optional, they are still needs to be done by all the businesses. Second relief that we will be discussing is qualifying free zone person relief, and one of the very key provision of the of this corporate tax. One of the key area where businesses focused in when they are doing the businesses in the UAE, also when they are coming newly in the UAE for doing the business. This is the key relief that everyone talks about. How can we qualify for a qualifying free zone person? So, starting with who can be a qualifying free zone person, for that you need to have your entity in the free zone. In the very starting, we discussed about mainland and free zone, and then free zone and designated zone. So, the starting concept of here is that your entity needs to be incorporated in the free zone for having this relief. This, when you have incorporated in your entity, if I see on the practical level, many times people says that my company is incorporated in the free zone, I am eligible for 0% tax rate. So does that mean that your entity is incorporated in the free zone, then you automatically go for 0%? The answer is no. The one and the very starting point is to have an entity in the free zone, but then you have conditions to meet out. When you meet out those conditions, then you may qualify for 0% tax rate, or else the standard 9% tax rate is applicable on you. So what all are the conditions that you need to fulfill to be treated as a qualifying free zone person or a QFZP? First is adequate substance. So you can't do this that you have incorporated a company in the free zone, but you are doing the entire business from mainland or any other part of the world, not from that free zone. So one of the most important condition is that the free zone that you are saying that you have incorporated the company, you need to do the business from there. You need to have adequate substance, adequate assets, adequate employees, your warehouse, your office, your not customers, but your employees needs to be there. So what authorities are encouraging here is they wants to have the business from that particular zone where you have incorporated the company. It's not that on paper you have the company there, but in substance you need to have a company there. Then there is a list of activities that are qualifying activities. So if you are doing those activities, then you can say that you may qualify for a QFZP purpose. We will discuss those activities in next slide. Then there is a de minimis requirement. So when in the first we said that there are a qualifying income, then there is still some portion of income which are not getting covered in qualifying income. Some other income, some bank interest, some cashback, some other indirect income that businesses may have, which are not forming part of qualifying activities. So the authorities here have gave the cap of 5%. That means if your 100% revenue, if your 95% of revenue is coming from qualifying activity, you can go ahead with QFZP. But if less than 95% revenue is coming from qualifying activity, let's say 90%, 80%, 70%, then you will not be able to meet the de minimis requirement. Then that means that businesses have 5% of leverage to earn other income, not more than that. Then we have arm's length transactions provision. That means all the qualifying free zone person needs to comply with transfer pricing regulation. All the related party transaction needs to be on arm's length market price to qualify as a QFZP. Audit is another mandatory requirement, because for other companies there is a limit of 50 million. If you have revenue less than 50 million, you can choose not to get your financials audit. But if you want to become a QFZP, even if you have 100,000, 200,000 revenue, you need to get your financials audited. Last but not the least, you should not elect to be taxed at 9%, because in the starting I told you that there is an option. You need to be elect. You need to comply with the conditions to become a QFZP, but you still have an option that you are complying with first five conditions. You have substance, you have 100% of your income from qualifying activity, then you do not have any related party transactions, or even if you have related party transactions, you are complying with transfer pricing regulations, you have audit also, but still you want to pay taxes 9%. Now we'll discuss later that why should someone will pay taxes 9%, that I'll explain later. But you still have an option to not to be a QFZP. So you should not go for that option not to be QFZP, uh, to take the 0% tax rate. Just I would like to highlight one thing here, which is a clawback thing. That for 1 year, if you do not meet any of these conditions, let's say I incorporated my company in this year, but I failed to have a substance in first year, but I know that I have audited financials, I know that I'm complying with transfer pricing regulations, I know that I have qualifying income, but I just do not have substance for 1 year. So can I have my substance for second year and get this relief? The answer is no. For 1 year, if you do not disqualify, if you get disqualified for 1 year, you get disqualified for next 4 years as well. So once not a QFZP, you will not be QFZP for total 5 years. Then in sixth year, you can again see that whether you are complying with all the six conditions or not, and then you can go ahead and check that you can get a 0% tax rate or not. But it's very important to see that you lose it for 1 year, you lose it for next 4 years as well. You are not getting this option for next year. Now, next is what are the qualifying activities? Because in the first slide, we understood that you need to earn income from qualifying activities. So, few activities are defined by the law, which are majorly, if you will see the nature of these activities are bringing values to the economy of UAE, or bringing values to the economy in the world. Those activities are being classified as qualifying activities. If you are manufacturing goods, if you are trading in qualifying commodities, for example, carbon credits, chemicals, etc. If you are holding shares for investment purpose, because majorly the UAE has worked towards supporting investments by businesses, also by the natural persons. So holding of shares and securities for more than 12 months are qualifying activities. If you have headquarter in the UAE, if you are working for treasury services to your related parties, aircraft financing, or if you are in the distribution business, like you are selling the goods for resale purpose, these activities are the qualifying activities. If the free zone is doing this business, more than 95%, then that free zone may go for a QFZP. In this qualifying activity, I would just like to discuss one activity separately, which is distribution of goods, which is last in my table. Distribution of goods in or from a designated zone. So in the very starting of this webinar, I discussed about mainland free zone, and then in the free zone and designated zone. So above activities from manufacturing and processing of goods till aircraft and financing, you can do it from any free zone. It does not need to be a designated zone. But the last activity, distribution of goods, needs to be from a designated zone to qualify for a QFZP purpose. Then we have some list of excluded activities. If you are doing these activities, you cannot qualify for QFZP, which are basically not regulated activities or any transactions with natural persons which are not being qualified. Those excluded activities, if you have income from, you cannot become a QFZP. So we have discussed a small business relief, we have discussed QFZP relief. The third relief is participative exemption. Again, this is one of the core area which defines the intention of UAE authorities. They do not want to tax the income twice. So this entire participative exemption is preventing the same profit to get taxed twice, even in different countries. So if you have shareholding of more than 5% in any company, and that company itself is paying taxes on their profit for 9% or more, that means what is the corporate tax rate in the UAE is 9%. If that entity in itself is paying either in the UAE or in any other country the taxes of more than 9%, and you are getting the income from that entity, then that income, either it's a dividend or it's a capital gain, that would be exempt from UAE corporate tax. One condition here is you need to have that security for more than 12 months, or you should have intention to hold that security for more than 12 months. That means if you are doing a very short term trading, then this exemption is not available for you. But if you are doing investment purpose and you are having it for more than 12 months, or you have intention to hold it for more than 12 months, then that dividend, that capital gain can be exempted from taxation, provided 9% or more tax has already been paid on that income. Last but not the least, in the relief is qualifying group. In the before, like previous slides, I discussed one concept with you all, which is on the tax group. When you have more than 95% shareholding, parent subsidiary relation, you can file a consolidated return. Then I told you about cons, that why one would not go for forming a tax group. They lose 375,000 threshold, they have more liability towards other businesses. So understandable that I was about to become a tax group, but I chose not to become a tax group for getting that 375,000 threshold. If I am not opting for tax group, do still I have some provision? The answer is yes. You still have some provisions if you are a part of a group. If you have a common shareholding of 75% between two entities, and you are following same financial year, you are following same accounting standards, then you can transfer your losses. Let's say in our example, one entity has 100,000 profit, another entity has 50,000 loss. Now another entity will file its tax return and carry forward that loss for like 6, 7, 8 years, and one entity has to pay tax on that 100,000 or 10,100,000. So what can happen here is that loss entity can transfer its loss to the profit entity. The profit entity's taxable income will be reduced by that amount, and they will not have cash flow issues. They can reduce their tax liability for the current year. The another relief available for common shareholding qualifying group is you can transfer the assets between each other in no gain or loss. So if parent entity is transferring one of its asset, one of its building to subsidiary, and there is a capital gain of 500,000. In that 500,000, the parent entity has to pay taxes because capital gain is being taxed in the UAE. But if they are part of qualifying group and there are few conditions, if they are meeting those conditions, then they can transfer this on cost. So that means in the parent entity, if it was 100,000 asset, they can transfer it on 100,000 and there will be no capital gain. So they can again reduce their tax liability or cash flow issues in this relief. Then we have business restructuring relief. Many times the groups or different entities go for merger, demerger, acquisition, then the law has few conditions, and if you meet out those conditions where they says that you should have substance for that, you should have reasons for getting the restructuring, it should not to just to avoid corporate tax. If you are meeting those conditions, then those merger acquisitions can be treated as on no gain and loss, and you do not have to pay taxes on those restructuring. And then we have the or calculation of its own loss. Like if I'm carry forwarding my own loss, then how it will be treated in the future years. So the number one thing is you can carry forward your loss for as many years as you want. There is no years defined that the loss can be carried forward only for 10 years, 15 years, 20 years. You can carry forward it for indefinite period. But when using those losses, you can only reduce your taxable income by 75%. So if you have 100,000 of your net taxable income, then you can just reduce that taxable income by 75%. You still need to pay tax on the rest of 25. And then the remaining tax loss will be carried forward for the next year. In this example, I have explained the same thing, that how we offset 75% of taxable income in the year. So if you have 100,000, if you have a tax loss of 1 million and the another entity has a taxable income of 1.2 million, so the another entity can only reduce its taxable income by 75%. They still need to pay tax on the remaining 25%, and then if any loss is still available, it can be carried forward for the next year. After this, we would be discussing what are the timelines of the compliances that are required. So starting with, you need to register your entity. The registration timelines are depend on the license issue date. So whenever any entity is getting incorporated in the UAE, they get a trade license. In the trade license, they have a license issue date, which is basically in most of the cases the date of incorporation. So once you have incorporated your company, you need to register your company under corporate tax within 3 months from the license issue date. Then you need to file your return within 9 months from the end of your tax year. So if you are following January to December, you need to file your return by September of the next year. So our tax filing periods are here. We are currently working on the tax returns of the companies for 2025. The due date for them is September 2026. And once you cease your business, you liquidate your business, you close your business, you need to deregister yourself within 3 months from the date you trigger that event. What are the penalties? If you do not register on time, the penalty is 10,000 dirhams. If you not deregister on time, the penalty is 1,000 per month. And if you do not file the return on time, the penalty is 500 per month. And then it goes every month. So these are the three major compliance events that needs to be done by all the companies. Moving ahead, we would be discussing how to compute taxable income to get that on what amount you will be paying 9% tax. I'll just give it to Pooja ma'am for a brief about this.
Perfect. So as we've seen that how the reliefs are calculated, how what are the provisions for taking reliefs. Now we have also seen the timelines, the administrative registration timelines, the filing, the deregistration, when it needs to be done. So there's a standard timeline of 9 months from the end of the financial year for filing your tax returns and also paying the taxes. The taxes also need to be paid within the same timeline of 9 months. Going ahead, we are going to see in the upcoming slides about how the taxable income is calculated. Now, basically, when there is an accounting income in UAE, we follow IFRS. So, based on the international financial reporting standards, your book profits, your net profits are calculated, and then there are certain disallowances. That means the adjustments that are done, like certain common things which are disallowed. So the fundamental here is when we say is the two tests that the expense must be incurred wholly and exclusively for business purpose. The moment it satisfies this condition that the expense is wholly and exclusively done for business purposes, the second test is that what supporting documentations we have to prove that it's a business expense. Any expense that is cannot be having, it has a mixed nature, like we're going to see entertainment expenditure, then those entertainment expenditures by law they've put a standard limit of 50-50. So 50% they allow and 50% they disallow, like the expenses that have a mixed kind of nature where there is a personal expense involved and a business expense involved, that has been categorized for a 50% exemption. Then there are certain other expenses which we are going to just see what are not deductible in the UAE tax laws. So let's go for it and let's have a look. Also, we will be walking through the tax return format and the tax portal. So, Vaishnavi, unmute. Yeah.
Thank you, ma'am. So, as ma'am said, that the starting point of calculating the taxable income is the accounting net profit, which is being followed on the IFRS level here. IFRS is mandatory on all the taxable persons, and the net profit that comes from their financials, from their audited financials, is the base to start the calculation of taxable income. Then the few add backs or exemptions are provided in the law, which after doing that, we will be getting a taxable income. Common add backs I would be discussing here, which are not deductible or ineligible for corporate tax, are entertainment expenses. What do we say in the client entertainment expenses? If you're giving gifts to client, you're going on lunch with the client, you are throwing parties for your clients or vendors. So the law says that these type of expenses have some personal nature available. They are not 100% business nature, but you are maintaining, you might be having some personal relations, personal portion there. That's why law has said that these type of expenses are allowed up to 50%. The rest 50% will be disallowed if you are paying any fines and penalties for legal non-compliance. So we can have two types of penalties. One is the statutory penalty. Second is the compensatory penalties, like which happens between customers and vendors. If you have not paid by this date, they will put a penalty on that. So the contractual penalties are allowed. The legal and the statutory penalties are disallowed. Then if you are paying any dividend or if you are distributing any profits to the owners, then it is disallowed from taxable income. Then if you are donating any amount, you need to donate it to the qualifying entities. So there are a list of qualifying entities being issued by the department here. If you are doing any donation outside that, that donation is disallowed. Then any taxes, any withholding taxes, any direct nature taxes that you are paying, that are not allowed from reducing from the taxable income. And if any non-business expenditure is there, any expenditure you do not have supporting for any personal expense, those are not allowed to be reduced from your taxable income. So if they are already reduced from the accounting income, the taxable persons are required to add them back. Then we have certain exempt income. If those exempt income are added in your accounting profit, you need to reduce it. Those are dividends. If you have received any dividends from participative exemption part, if you have any foreign PE election, so there is a concept of foreign PE here. where you have a permanent establishment outside UAE and you are paying taxes there for more than 9%, you can opt not to pay tax here. So if you have any such exemptions available and those income are covered in your accounting profit, you need to reduce it. Once you add back the non-eligible expenses and reduce the exempt income, then you will get your taxable income. Then when you will have your taxable income calculation available with you, you will be going on the portal and you will be filing the tax return. So here, how the format of the tax return is. In the very first section, you need to provide the entity details, its name, its license, its tax period, owner's details, all those uh, company related details. In the second section, you will be providing your accounting income. You need to report each line item of your profit and loss and your balance sheet. And then there would be a columns for adjustments like adjustment for entertainment income, adjustment for fines and penalties, adjustment for dividend, adjustment for exempt income. Those all adjustments will be done. In section number third, there will be an option for the reliefs and exemptions. Whether you are going for QFZP relief, whether you are going for participative exemption, whether you are going for a small business relief, those or reliefs elections will be available. Then once you put your accounting and taxable income and you choose for which relief you are going, for which relief you are not electing for, you will get your tax liability calculated. Then if you have any foreign tax credit available, those foreign tax credits will be reduced and then you will get that how much tax you needs to pay. Then you will be paying those taxes on the net taxable income. Then few declarations are there in the tax return in which I will be discussing it in the next slide. But if you go above those threshold, then you need to disclose few transactions in your declaration. Then the final section is attachments. You need to attach your financial statements and certain supporting schedules if required, depending on what return you are filing. If the discussion that we had previously about calculation of corporate tax liability is first if we go with the example, the company is incorporated and following the tax period of 31st December 2025, so their tax return will be due in 9 months, which is 30th September 2026. Say they have a revenue of 8 million and they have a net business allowed expenses of 2 million, then their net profit would be 6 million. So how this 6 million will be taxed? In the first 375,000, there would be no tax. In the remaining 5.6 million, they need to pay 9% taxes. So they have to pay the net tax of 500,000 6,250 in AED for the tax period of January 25 till December 2025. Now, what we were discussing in the previous slide about the disclosures required in the CT return, if you have any related party transactions, related party means any entity having common shareholding of more than 50% and like having common controls of more than 51%. If you are following in this list and you are having those transactions with the related party more than 4 million, then you need to disclose each of those transactions while filing the CT return. What will you be required to disclose? You will be required the name of the entity, in which country that entity is, what type of services you are having with that entity, what amount you are paying to that entity, whether that amount is complying with arm length transaction or not. Do you have what is the market price of that transaction? All these all these detailed disclosures are required to be submitted at the time of filing the return. But these disclosures are required only if the transaction with the related parties are more than 4 million. Then we have connected persons. Connected persons means the individuals who are having control in the entities, say directors, say ultimate beneficial owners, relatives of directors, relatives of manager. If you are having transactions with these persons more than 500,000 AED, then you need to disclose. What do you need to disclose? You need to disclose what is the name of the person, what is the relationship with that connected person that you have, whether the transaction is on arm's length or not, what is the market value of those transactions. These disclosures are to be submit at the time of filing of the return itself. Then, when is the audit required? Mandatory for corporate tax purpose. So, if you have a revenue more than 50 million, then you are required to do the audit. If your revenue is less than 50 million, it's optional, not required under corporate tax law. Then, if you are a qualifying free zone person, or if you are opting for forming a tax group, both of these two concepts we covered previously in our slide. So if you're going with both these options, then you need to have your audit done irrespective whether your revenue is 50 million or less than 50 million. I would just be covering one practical thing here. Though the law says that if your revenue is less than 50 million, you do not need to have your financials audit, but still here licenses get renewed every year. Whenever you renew your license, many times free zone authorities ask for your audited financials. So sometimes business get their financial audited anyhow, even when they are mandatory required it under corporate tax or not. And here I would be just walking you through with certain recent developments in the corporate tax, which we have already discussed in our corporate tax session. The SBR has been extended till 2029. Previously, it was only till 2026. It was available only till 2026. Now, authority has gave 3 more years for the small businesses. Then the second is domestic minimum top-up tax. It's being introduced from January 2025. Then there is a agreed upon procedure report, which is for QFZP who are engaged in distribution business from designated zone. So very recently, last month, authorities has issued this FTA decision, and this says that going from January 2026, distribution businesses are required to have a separate report from the auditor. That report will confirm that you are complying with all the requirement to be a QFZP for that year. And then very recently, they have also added that all the tax groups are required to have their books consolidated financials audited. So these are the few key amendments that we have seen in last 6 months or a year. Then in the corporate tax, because many of you are sitting in India and working very closely with the India income tax, and we are here describing about UAE corporate tax, most of the businesses sees that how the India UAE DTAA works and how does businesses get benefit from it. So UAE has active DTAA with India, and that DTAA is active since 1993. And practically, we see many of the businesses taking benefit from that. What benefits they are getting from India UAE DTAA? They get reduced withholding taxes. They have a very defined tiebreakers rule that which income will be taxed where, and if any individual or any entity is getting taxed in both the country, or if they are being treated as resident in both the countries, then they have a tiebreaker rule that how they will come as a single residence from a dual residency case. Then how do people take relief from the provisions that are available in DTAA? In India, they file 10F to get those relief. From UAE, they get TRC. So once they get the TRC, they sometimes submit it to their India vendors or India customers and get benefit from reduced withholding taxes. Who can apply for the TRC in the UAE? Because TRC is one of the core document that you may be many times asking from UAE customers or from the UAE individuals. If you are a natural person and you are living in the UAE for more than 6 months, in number of days for more than 183 days, then you can apply for TRC in the UAE. If you are a UAE incorporated company, you are a resident and you can apply for a TRC in the UAE. But whichever period you are applying, you need to complete 3 months in that period. So, for example, if you want a TRC for January 2025 till December 2025, you can apply it after March. You have January, February, March, these 3 months you have completed. Then on in April, 1st of April, you can apply for TRC being a juridical person. TRC you get only for 1 year, and then you submit this TRC to your India customer, vendor, or entity, and then you get benefit from the provision of India UAE DTAA. So, comprising the entire corporate tax, which is being effective from practically from January 2024, companies has paid their taxes first year. Now this year, most of the companies will be filing their second corporate tax return. We have seen this journey. We have seen how the very first federal degree law was came, then explanatory guide came, then many decisions came. Authorities were very active in solving the business's problems, solving the technical issues, issuing the clarifications. Businesses are also now have the system in place for the corporate tax. This whole journey was a very inspiring journey when we see from introduction of law to implementation of the law, and the entire base of the corporate tax was to make it simplified, to make it compliant with the international regulations, and still maintain the reduced rate, tax rate. From the worldwide perspective, UAE has really seen this journey. Businesses has really adopted it very well, and businesses are still doing these things. We, as of now, we are all ready to file the corporate tax return by 30th September. This is basically what corporate tax in the UAE looks like. I would hand it over to Pooja ma'am before we move ahead to the indirect tax, which is VAT.
Thank you very much, Vaishnavi. I think it has been very well summed up. And yes, so this is an overview of the UAE corporate tax, which comes under the direct taxes. And we look forward to now discussing having just a touch base of the indirect tax, which is value added tax. So uh, the VAT brief and applicability, if we see here that VAT is an indirect tax, the way it works as a goods and services tax in India. It's a consumption tax based on more for goods and services, and it was introduced and made effective from 1st of January 2018. That means businesses collect it, and it is the end consumers who ultimately bear the burden of the VAT. Now, the registration requirements for VAT are that if your turnover of the company crosses AED 375,000 dirhams, that means in the last 12 months, if my turnover crosses 375,000 dirhams, I am mandatorily required to register for corporate tax. There is another registration threshold, which is of 187,500 dirhams. That is a voluntary registration limit. That means if the turnover of any company is, for new company, if the turnover of the company is from 0 to 187,500 dirhams, you are not required or you're not eligible to take a VAT registration. Once your turnover crosses 187,500 up till 375,000, you can take a VAT registration. It's voluntary. But the moment your turnover crosses 375,000 dirhams, you get only 30 days to register for VAT. A unique identification number called a tax registration number, TRN, is issued, which is a 15-digit number issued to every business which is a taxable entity. And it follows a quarterly return filing system. The way in corporate tax, we have seen that it's an annual system of return filing. VAT follows a quarterly system of return filing. Now, in the upcoming slides, we are just going to discuss about the tax rates of VAT. Also, we will see the tax rates, like the standard tax rate is 5%, which is comparatively, if you see in other jurisdictions, it's really low. So even the 9% rate and even the 5% VAT have been kept substantially very, very low compared to the jurisdictions. So we are just going to see how the supplies are distributed between standard, zero, and exempt. Also, a new concept has been introduced and is already, getting implemented very soon, which is of e-invoicing. That also we are going to touch in the upcoming slides. So let's see what are the rates of VAT.
Thank you. Thank you, ma'am. So, as ma'am has already briefed about the mandatory threshold, so VAT is an indirect tax which is as good as GST in the India and is applicable in force in UAE since 2018. All the businesses are mandatory required to register if their turnover is more than 375,000, and they have an option to go for voluntary registration as well if they have a revenue of 187,500. If any foreign person is doing business here, any non-resident person is doing business here, there is no threshold. They need to register in the UAE irrespective of any limitations if they are making supplies to any non-registered person in the UAE. In in that we have only two rates, it's 5% or 0%, or either there are few exempt supply or out of scope supplies. So majorly all the goods are taxed at 5%, which are local supplies. If you are making any zero rated supplies, any export of sales, export of goods or export of services, then they are being taxed on the 0%. And then few supplies are categorized at exempt supply in the UAE, which are financial services, sale of bare land, local passenger transport, residential property transport. These are few supplies which are exempt, so they do not even trigger the registration requirement if the businesses are only engaged in exempt supply and there are no tax paid our requirement. What are the filing periods and compliances? So most of the businesses follow quarterly returns here. Few businesses follows the filing of VAT return on the monthly basis where the turnover is more than 150 million. And when taxes returns are due, it is due in the 28th day of, so for example, if you follow January to March, so your return will be due on 28th of April. So every 28th, the return will be due. It's not being filed like on 10th, or like in India, we follow GST1, GSTR 2B, GSTR 3. That is, here we file a single consolidated return which have all the details of sales, import, exempt, uh, exports, imports of goods, RCM. All the details are being filed in a one single consolidated return which is filed on 28th day, and on the same day the tax is also being due. Now we have a new concept which is now applicable in the UAE is e-invoicing and will go live on 1st of January 2027. So UAE has introduced the concept of e-invoicing and it is following the PAPEL model where we have five corners, and currently practically what businesses are engaged in, they are getting ASP, which is Accelerate Service Providers. They are implementing that provisions here. They will be appointing them. So starting with the revenue which are having the turnover more than 50 million, they need to appoint a ASP by 30th October, which is next 3 months. So most of the businesses have already started implementing this. They will be appointing a ASP by 30th October, and then from January 2027, the e-invoicing will be live. They will be issuing all the invoices from that ASP portal. For July 2027, e-invoicing will be applicable on all the businesses. So they have divided into phases. In the first phase, they are only targeting the companies which are having the revenue more than 50 million. Soon, mid of 2027, all the companies doing businesses in the UAE will be covered in e-invoicing concept. In the VAT, it was introduced in 2018, and VAT was one of the major decision that that the UAE authorities has taken, because it was first tax that was introduced almost on all the businesses, and it's been 8-9 years now authorities have been very supporting at the time of supporting the businesses, be it private clarification, be it any technical issues. We can call FTA, we can get the answers from them. So it has always been very easy on that part. I would say that very convenient to get in touch with the authorities, get the answers, get the issues resolved. They have always been very active on that part of supporting the taxable persons. Now we have the last section to cover for today is how the returns are being filed online platform, which platform is being used. So we use here the Imara tax platform for all the taxes, which is corporate tax, VAT, e-invoicing. We have one digital portal and it is being used for all the tax purposes. So if you see on the slide, we have the portal here. In the same portal, you will see all the registration overview of a taxable person, whether that person is registered in corporate tax or not, whether that person is registered in VAT or not. If you have a tax group, it will come here. If you have excise tax, it will come here. If you are a pillar 2 top up tax, it will come here. So you have a single platform for filing all the returns. If you go in this VAT section, you will see the VAT returns. In excise section, you will see the excise returns. In corporate sections, you will see the corporate tax returns and payments. In my payment section, you will see all the payments that you have made to FTA. You can download your SOA. If any audit is being uh, initiated on you, you will see it on my audit portal. If you want to apply for TRC, you want to apply for any other services of FTA, you can get it from here. And for e-invoicing, they have a separate tab. So this is the platform that all the taxpayers use and they get all their details from here. Now, if I'll just quickly wrap up from starting like a decade before, there was no taxation in the UAE. It was in the grey list. It was used to be seen as a tax haven for many tax laws. Now coming here, we have VAT, we have implemented corporate tax from 2025. The OECD Pillar 2 regulations are here from next 2 months. E-invoicing will be live for all the businesses. UAE has really adopted all these taxations in a very better way, helped made it easy for the businesses here to adopt and also helped businesses to work and get implemented all these regulations being introduced by the authority. I have tried to cover mostly all the provisions of both the laws, and I'll open the floor now for the questions and the discussions if any of you have. Before that, I'll just hand it over to Pooja ma'am to conclude this. Thank you.
Thank you very much, Vaishnavi. It was very insightful. And I would say that, yes, the UAE tax landscape has been evolving and it will continue to evolve. We are anticipating some new laws to come in. Already, there are a lot of laws that are being implemented, and so are the opportunities around it for professionals like us, for tax professionals who are continuously working in and around the tax laws. So let's keep learning. Let's start, participate more in such learning sessions. And most importantly, keep asking questions, stay curious. Let's keep this learning journey on. And with this, I want to thank the whole team of Kalani and Company, Jay Kumar Tejwani sir and company, to organize such fantastic sessions and take this initiative and also give us this opportunity to be a part of these sessions. So it's really, really, I would say, appreciating that we are sitting here in two different zones, in two different countries, and learning UA taxes. So hats off, and really thank you, sir, for doing this and organizing this.
Yes, I request Tejwani sir to also please say a few words as well as in this webinar,
So,
as well as on UAE taxation. Yes.
thank you. Thank you. No, I think everything is very, very well explained and said. And Vaishnavi, in fact, I learned a lot of new things. Huh? I keep presenting, but I'm going to carry a lot of things from this presentation. And both of you were just amazing, very nicely presented. And the concept, I would say, were well integrated with the compliance. And in such a short duration, the entire UAE corporate law, if we are all alert, we at least would have a very good understanding. And Pooja, you were a wonderful keynote speaker, again giving insights into the subject so thoughtfully that and simple also, in very simple language. So thank you so very much to both of you. And I'm not sure whether you have taken your lunch or not. It's 1 p.m. your time. So anyways, and also both of you and to all of